2024 is coming to our door, and while 2023 has been a booming year for the stock market, there are still great Canadian dividend stocks that are currently trading at discount. So today I'll share with you 3 great Canadian dividend stocks that are currently undervalued and that are offering great potential of upside in 2024. Without further ado, let's take a look at my pick number 1. The first business on my list is the Bank of Nova Scotia with the ticker BNS. This member of the Big 5 Canadian banks is currently the most undervalued ones among all of its peers, where it has been down by about 5% in 2023, while giving about 6.50% of quarterly dividends to their shareholders. Add to this, if you're looking for great geographical diversification in the financial sector, this type of bank could be optimal for you. Indeed, the Scotia Bank is considered as the most international Canadian bank, where it has notably some high exposure to the South American market. By looking at their more recent earnings report, we can see that their international branch is their second largest branch, just after the Canadian banking branch, where it represents about 41% of their total net income. Inside of that branch, we can find great exposure to the US market, as well as high exposure to the Pacific Alliance countries such as Peru, Chile, Mexico, and Colombia, as well as Brazil. However, the big problem that this bank has been facing lately is coming from the massive hikes of the interest rate. In fact, the first aspect of this bank that has been impacted by those numerous hikes of the interest rates is coming in terms of their provision for credit losses. The PCL, or the provision for credit losses, is simply a provision from the company in terms of the potential losses that will be coming from the credit risk. So this represents the risk that certain borrowers, let's say a family that buy their first house, won't be in that case able to repay their mortgage. And in fact, by looking at their more important branches, which is the Canadian banking branch, we can find that their provision for credit losses has been increasing by over 300% compared to 2022. At the same time, the other aspect that is highly impacted by the hikes and the fluctuation of the interest rates is the interest income that this bank will be able to generate. This type of earnings comes from the difference between the revenue that the bank's assets linked to the interest rates will be able to generate, and so you will subtract this amount with the expenses that the bank will have in terms of the liabilities linked to the interest rate. As they mentioned in their fourth quarter earnings report, the impact of an immediate and sustained 100 basis point increase of the interest rate would be a diminution of about $99 million of their net interest income. And so we can see that the impact of the recent hikes of the interest rates have been diminishing their total net income year over year by about 26%. However, in the other scenario that is predicted by many analysts for 2024, where we should see a certain diminution of the interest rate, with a diminution of about 100 basis points on the interest rate, this would result in a $68 million increase in their total net interest income. So, with all of these news and the potential stop of the hikes of the interest rates in 2024, this could become a massive buy for many investors. Now, the second company on my list is the telecommunication business Telus with the ticker T. On its side, this business has also faced many kind of difficulties in 2023, where the company's value is down by about 10% in 2023. And in fact, on their side, this decrease in their valuation has been linked to multiple factors. First, over the last couple of years, we've seen that Telus has been spending a lot of money to improve their capital infrastructure, notably by installing different 5G technology, but also by acquiring large portions of wireless spectrum and installing fiber optics across its network. All of this makes that Telus now has one of the best quality networks among all of its peers, with about 90% of their total networks that is covered by high-speed coverage, combined with other multiple acquisitions in the past, notably with the acquisition of the company LifeWork that is now known as Telus Health. However, all of these new expenses have been massively impacting their total debt that has been increasing by about 10% since 2022, and on their side, the average cost of their long-term debt is about 4.33%, which is quite lower than the current interest rate, but that is still way higher compared to what it was in the past. In the third quarter of 2023, the big increase in the restructuring and other costs have been massively diminishing by over 75% their total net income. At the same time, even if the Canadian telecom market is basically divided between 3 companies, which are Bell, Rogers, and Telus, with the push of smaller companies such as Quebecor lately, we've seen a lot more competition innovation in that field. Nevertheless, the positive and bright point for the investors lately is about the Telus management board, where they have notably acknowledged the problems in terms of their total profit margin, and it is why they've committed to aggressive restructuring, layoffs, and efficiency efforts to increase their profitability. Plus, in the third quarter of 2023, their total customer growth has been of about 406,000 new customers, which is up by about 59,000 new customers over last year, an all-time high quarterly record, which have helped them to also increase their adjusted EBITDA as well as their operating revenues and other income. Add to this, they recently announced a new quarterly dividend increase where their dividend is currently sitting at about $0.38 per share per quarter, which represents an increase by about 7.1% compared to last year. This makes that their total annual dividend yield is sitting at about 6.50% right now. For comparison, the last time that their dividend was sitting over 6% was during the financial crisis between 2008 and 2009. And so with the project migration and the cool down of the interest rate over the next couple of months and years, this type of business could be particularly interesting for many investors in 2024. And finally, the third and last pick on my list is the company TC Energy with the ticker TRP. Compared to the two other previous picks that I've just presented to you, this type of business hasn't lost a lot of value in 2023, but what makes it very attractive for investors at the moment is their massive dividend close to 7% right now. On its side, this company offers natural gas and oil liquids to a big portion of North America with their 100,000 kilometers pipeline, but they also have 7 power generation facilities with also multiple renewable energy sources. The great news about TC Energy that just came out in their latest earnings report is about the completion of their new Coastal GasLink pipeline in the west of Canada, which will be slightly ahead of its year-end target while maintaining its budget of about $14.5 billion cost estimated. This will help them to deliver natural gas faster over 670 kilometers in the west of Canada, where the Coastal GasLink pipeline will safely deliver natural gas from the Dawson Creek area to the LNG Canada facility. However, just like the two other picks on my list, TC has been highly impacted by the recent increase of the interest rates, where their total debt has also been increasing by about 10% year over year. Unfortunately, it means that even if they've been able to see some great growth in their total revenue, well, their total expenses have been quite importantly increasing as well, which have made their total earnings diminish and even become negative in their latest earnings report. At the end of the day, as an investor, I personally believe that many oil companies such as TC could be particularly interesting at these levels, and since we know that the oil price in general will tend to follow the inflation, we've seen that recently with the potential news of a slowdown of the hikes of the interest rate, well, it has made that this type of business has restarted to grow in value. And so I believe that this type of company could be a wise option for many investors looking to have a 7% dividend stocks in their portfolio, as well as investors looking for great potential capital appreciation if the interest rates start to slow down, which means that the inflation should restart to grow. So there you have it. Those are 3 great undervalued stocks in my opinion that could be worth having on your watch list for 2024. But on your side, if you're looking for more diversification in your portfolio to grow your total net worth as much as possible over the next couple of years and decades, well, check out the video that's gonna be right over here, and I will see you soon. Peace.